Could you handle 11 interest rate rises in only 15 months? Hello everybody, it's Leith van Onselen, the unconventional economist, chief economist at macrobusiness.com.au and the MB Fund, coming at you again with another macro breakdown, where today I want to talk about the market's crazy latest forecast on Australian interest rates. As I mentioned in my last video, markets were tipping that the Reserve Bank of Australia would lift Australian interest rates by 2.25% by the middle of 2023. Well, as often happens on YouTube, a mere 24 hours after taping my last video, the markets revise up their Australian interest rates forecast by another 0.4%. That's right, the markets are now tipping that the Reserve Bank of Australia is going to hike interest rates by 2.65% by mid-2023. Now, as shown in the chart in front of you by the yellow line, this would represent the fastest and largest rate rises in the developed world, beating the Federal Reserve, the Bank of England, the European Central Bank, the Bank of Japan, and the Reserve Bank of New Zealand. Now, by my calculations, taking the median monthly mortgage repayment on the median priced home over a 30-year principal interest loan with a 20% deposit, lifting interest rates by 2.65% would lift typical mortgage repayments by 36%. This would mean that the monthly mortgage repayment on the median priced Australian home would rise by $930, whereas in the more expensive markets of Sydney and Melbourne, monthly mortgage repayments would rise by around $1,400 and just over $1,000 respectively. Now, as shown in the chart on the right, such a large increase in mortgage repayments would lift Australia's debt servicing ratio, that is principal and interest repayments as a proportion of household disposable income, to their highest level since the global financial crisis hit in 2008. If the RBA was to raise interest rates by 2.65% as predicted by the market, recent highly leveraged borrowers would be in a lot of trouble. As shown in this chart, the percentage of mortgages originated at high debt-to-income ratios, that is, a debt-to-income ratio above 6, has risen sharply over the pandemic, from around 15% pre-pandemic to nearly 25% in the December quarter 2021. In fact, there are $265 billion worth of mortgages undertaken since March 2019 that had debt-to-income ratio of more than 6 times. This means there's a massive pool of borrowers who are very sensitive to interest rate rises. So if mortgage rates were to rise by 2.65%, as predicted by the market, there'll be a lot of households under severe mortgage stress. The impact would arguably be most severe on recent fixed rate borrowers. According to the Commonwealth Bank of Australia, $500 billion worth of fixed rate mortgages will expire over the next 2 years. And most of these mortgages were originated at interest rates between 2.25 and 2.5%. Therefore, these borrowers are facing more than a doubling in mortgage rates when their fixed terms expire. Clearly, a doubling in mortgage rates would represent a severe blow to household finances. So what's the bottom line here? Well, just like last time, markets are absolutely deluding themselves and are dead wrong on Australian interest rates. Such a massive and fast increase in interest rates would very likely crash the economy and crash the housing market. Thankfully, the lever is in the hands of the Reserve Bank of Australia, not the markets. And there's very little likelihood that the Reserve Bank would lift rates nearly as aggressively as the markets are predicting. For what it's worth, I'm tipping the Reserve Bank of Australia will lift rates for around 1% starting from late 2022. Anyway, that's all from me today. Just want to give you another quick update on what our crazy markets are thinking about Australia's interest rates and why they're dead wrong. If you like this video, please leave a like and subscribe, and I'll see you in the next video. Thanks for watching.